Welcome to today's SilverOak quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. With me today, as usual, is Jonathan Charlo, also a partner and our lead analyst. So welcome, Jonathan.
Thank you, Shannon.
Today's webinar will last approximately 45 to 60 minutes, as past ones have lasted. If you have any questions throughout the webinar, we encourage you to reach out to your SilverOak advisor. If you're not currently working with an advisor here at SilverOak, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and John and everybody else that's worked very diligently over the last couple of weeks in gathering this data that we're going to share today, and also to all those that were involved in getting the technology set up for today's session. That's much appreciated. For compliance purposes, I must note that we will be discussing the overall markets and economy during today's session, and in doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received over the last couple of weeks their year-end performance reports. And if, of course, you have any questions regarding those, please feel free to reach out to your SilverOak advisor if they've not already contacted you. And the last, most famous disclosure of all is past performance is no guarantee of future success. So with that, Jonathan, let's take a look at the agenda. As is typical, we'll start with a discussion around the economy, and then we're going to go into the SilverOak dashboard. We'll talk a bit about market performance, particularly for the last quarter and all of 2022. Then we'll discuss our outlook moving forward, both in terms of the economy and the markets. Since it is January, we'll talk about New Year planning tips and provide some SilverOak updates as well. We have a special topic today. We've put together some information on the Secure 2.0 Act that was just recently passed as part of the omnibus bill that went through Congress and the president signed. Again, at the end, if you do have any questions, we encourage you to reach out to your SilverOak advisor. And also, if you have any topics that you want us to cover in future webinars, I would encourage you to bring those topics to our attention. We really appreciate your input into how these sessions are designed and the topics discussed. So Jonathan, on the economy and SilverOak dashboard, where do we stand?
I think we're going to see really a theme throughout the slides as we go through them, is that things have rolled over and we're seeing slowing momentum in the economy among different indicators within the dashboard. And generally, you know, the thoughts going on right now is we know that the Federal Reserve is still likely going to raise interest rates at least maybe 2 more times is the expectation. And the debate is whether we're entering a soft landing, which is that growth just slows, or whether it's a hard landing and we actually go into a recession. And if that's the case, we've argued in the past that it would be a mild recession.
So with that, let's take a look at the dashboard. And as everyone knows who at least has attended prior sessions, our dashboard is made up of 4 components. The economy, which has 11 different individual factors, but overall, we put those into the economy component. And we'll see here that for the 4th quarter, the economy continued to score red, which is poor. And we're actually projecting that to be the case over the next quarter or two. The credit markets, that fell during the fourth quarter from green, which signifies more positive, to gray, which is neutral. And we expect that to continue for the next couple of quarters as well. Now, valuations may be the only of the components that actually improved a bit. And we'll touch a little bit on that, but do you want to kind of at a high level give us an indication as to why valuations would have improved?
Well, the only positive you can really get from the market performance this last year being down is that valuations have come down as well.
Sure.
So that's the positive. But we're going to talk a little bit about valuation, which is price versus earnings, and potentially earnings might be in the process of coming down.
Okay. And then, of course, the last of the four components being market sentiment. And that continues to be red, and it has been for the last couple quarters, although if we look a little bit further out, and our crystal ball is just as good as anybody else's, and they're all cloudy, but we would anticipate at some point that market sentiment to shift, and a lot of times it will shift pretty dramatically from real negative to quite positive. So that gives us the composite, which remains in the red as well. So let's look at the dashboard in terms of our line chart, and we'll see that the trajectory going back here over the last couple of quarters has been to the downside. And now the current composite has declined to a score of 1.94%, kind of below that 3.15 threshold level, and certainly below the last reading that we had of this data. And the 6-month composite has declined to 2.14, also well below its threshold of about 3.25. So signifying, obviously, all the data that you kind of alluded to, that the economy just is starting to slow. Let's touch on some components of this, though, Jonathan. So talk to us maybe about some of the components of the economy. And here I think we have the leading economic indicators.
Yeah, so this is one of the major components within the economy section. And here we're just seeing that continued downdraft in the leading economic indicators. And in this quarter, we've now broached that dotted yellow line, which in the past did signify that a recession would occur.
And the ISM manufacturing data?
A very similar story. It has come down. Now the red line and the green line on this particular slide are actually significant points within our model in the dashboard. And so really when we look at manufacturing activity, we're kind of at that pivot level, likely to go lower, again, signifying a recession.
Yeah, okay. And then outside of the economy, let's transition to the credit markets and that credit component of the composite.
Yeah, so here we're showing several different credit spread indices here. Last quarter, we really talked about the 10-year versus the 2-year. What we have seen this quarter, being the fourth quarter, is almost all of the credit yield curves are now inverted, meaning the longer term yields are lower than the shorter term. And typically in the past, that meant that kind of lending would slow and the overall economy would slow. Hence, it has been a good to very good indicator of recessions in the past.
Now, we've talked a lot about the negatives, but you did say the valuations had started to look better. maybe not for great reasons, but started to look better. So talk us through the PE.
Yeah, so during the pandemic, we did see valuations go above the 25-year average, and in fact, we're well above one standard deviation, so overvalued. Now we're kind of right back at that 25-year average.
So not cheap, but not
expensive,
crazy expensive.
But again, this has come down because of the markets coming down.
Right. Okay. And you mentioned corporate earnings, and there is a lot of focus right now on earnings. So, what have they forecasted? What have we started to see with earnings? Because that usually is maybe the last shoe to drop in the market cycle.
Yeah, we are actually starting to see earnings come down a bit. Now we're kind of in the early stage of Q4 earnings. And in the last month, we've actually seen those expectations come down. So we're really looking at potentially kind of down in the 3 to 4% range. And in that same time period, Q1 and Q2 estimates have now come back down as well, from kind of slight growth to maybe potentially slightly negative growth. And so even on this slide, when the data was available, it's actually come down a bit from there. And that's going to be important to valuation, because if the market kind of stays where it's at and earnings come down, then we're maybe a little bit overvalued.
Sure.
But again, the other side of that is, with earnings coming down, does the market come down further?
Well, and let's then touch on the sentiment component of the dashboard and the composite. And, we've shown this slide at least once in the last couple of sessions, but I think it's worth touching on again, because this slide is an indicator of consumer sentiment. So when the line is really low, obviously consumer sentiment is poor. When it's high, consumers are very optimistic. But the slide is a little counterintuitive, because when consumer sentiment's really low, then it projects strong expected market returns looking forward. Is that a fair assessment?
It's a fair assessment. And in fact, when consumer sentiment is high, it doesn't necessarily mean that returns are going to be negative, but definitely much lower. And so we're kind of at that point where in the next 12 months, at some point, we could see a real recovery, and we could see a nice rebound in the market.
Well, and I want to point this out, and I was going to do it a little bit later in today's session, but I think it's worth noting here and then repeating again later. And that is, right now we're talking generally about the economy in this section. In a few seconds, we're going to transition into the discussion about the markets. It's really important, though, for people to acknowledge that there is a difference between economy and markets. And many times, as a matter of fact, the typical cycle is that the markets will recover well in advance of the economy recovering, because the economy is backward looking and the markets are forward looking. So I just want to bring that up, because we've talked a lot about the economy so far. Now we're going to transition in to a discussion about more of the markets. Before we get actually into market performance data, though, tell us about market trends that we're seeing here.
Yeah, so in the overall dashboard, we are projecting at some point later this year that sentiment will improve, and certainly the market trend is actually one of those factors. And this is a little bit esoteric, but the green line is the 200-day moving average. The reddish line is the 50-day moving average. And so within the dashboard, when we see the 50-day cross below or above, that tends to be a turning point in our scoring process. And so what we're seeing with the markets above the October low is that the 50-day moving average looks like it could actually go above that 200-day line at some point in the next quarter or two.
Sure. Well, with that, let's talk specifically about markets and at least the performance for the past quarter or year. And we noted here, tough year, and I mean, obviously 2022 wasn't one of the historic bad years in the equity markets, but nonetheless, it was bad.
And it was historically bad in the fixed income market.
In the fixed income market, absolutely, and we're going to see that in a few minutes. Good point, Jonathan. But as we look at the overall performance, we're going to see on the equity side, actually Q4 ended positive. I think a lot better than most people realize, given if they're looking at annual numbers, they're still seeing double-digit negative. And so you'll see here, pretty much across the board, all of the equity markets for the calendar year were down 16, 18, 20%. But still strong performance there in the fourth quarter. The other thing that we'll touch on in a few minutes is that strong international performance in the fourth quarter. Of course, 2022, as we've mentioned, tough year, but it's coming off of 3 really strong years, 2019, 20, and 21. Now, you brought this up, Jonathan, and that is the historically poor performance that we've seen in the bond markets. It's not as noticeable looking at the Q4 data, but it's pretty apparent as we look at the full calendar year, with the bonds essentially being down more than they have been in history. In 60-40 portfolios, 60% equity, 40% bond portfolios having one of their worst years, which we'll touch on as well. So let's maybe drill down into more of the details and what are some of the trends, Jonathan, that we're seeing?
So let's talk about the whole value versus growth trend. We'll start with the large cap equities, and Q4 returns were positive again, and certainly value did far better than growth in the fourth quarter. And then when we look at the year in blue, that translated again to value outperforming. Now it was still down, so it was less bad, but that gap was almost 25 percentage points.
So that's especially considering so many years, growth has just dominated performance, but that obviously was not so in 2022.
Then looking at mid cap, again, very similar trends. The gap isn't quite as large. And I would say, you know, again, very similarly in small cap. So again, fourth quarter, generally everything was up, value did better, and then for the year, value was down less than growth across the board.
And how about in the international markets?
So across the board, surprisingly, I think for many people, international was up in the fourth quarter. And when we look at the year, again, most everything was down. Now, right in the middle, you'll see Latin America was actually up for the year. And that has to really do with the company weightings within Latin America. A lot more materials and commodity companies. And really, when we look at commodity returns, they were one of the only asset classes that was positive. And so that translated into positive Latin American performance. We'll show this, but one of the factors driving a rebound in international in the fourth quarter was the US dollar.
Sure. Well, and this is also a nice place to just reiterate that distinction between economy and markets. Because to your point, you said, you know, this was a surprise for a lot of people because the economies in a lot of these locations outside the US maybe are even closer or potentially even in recessions already, yet the market is looking forward and ahead of that.
Absolutely.
So you just mentioned the dollar.
Yeah, so the dollar in the fourth quarter actually started to come back down. Now, it had a very strong run earlier in the year, largely because the Federal Reserve was hiking interest rates so aggressively. And then what we did see in the fourth quarter are generally across the board in intermediate to long-term yields. We saw those come down a little bit. And as a result, the dollar actually weakened against some of the currencies, which provided, I think, a little bit of a tailwind for fourth quarter performance. But also, again, as you mentioned, the markets being forward-looking, I think they were looking ahead to things marginally getting better later in the year in international. This next year, meaning
Right.
2023.
Yes, yes. So we've talked a bit about equities. Let's transition into bonds, though, and discuss what bonds did both for the quarter and for the year.
So in the fourth quarter, we did see generally across the board positive performance within bonds. But one of the things, if we look to the right side, is you're going to see tips and treasuries were up the least. And generally speaking, government bonds with longer durations had been affected the most. Now they had a little bit of a rebound. But when you look to the left side, these were a bit more credit oriented. And so those saw a bigger rebound. Now across the board, for the year, we're seeing negative performance. And that was really more so driven by the increase in the Fed funds rate affecting the credit markets.
So with that, let's talk about what we expect going forward and discuss SilverOak's outlook. First, we'll talk about the economic outlook, and then we'll talk about the market outlook. So from the economy perspective, and let's focus specifically on the US, inflation's likely to continue, but we're going to see in a few seconds that it is moderating, obviously still remaining high, at least relative to the last 5 or 10 years. The Fed's likely closer to ending this hiking cycle, although we still think that they will increase rates February 1st, which is going to be, I think, the January 31st, and then the actual press conference is on February 1st, the next meeting, and then again in March. There, as you already alluded to, is that increasing probability of a recession. We still think mild recession, but we've been saying for the last probably couple quarters that we thought recession sometime in 2023. And a couple of things that really have come out just here recently to kind of back up some of these outlook items. One, PPI came out, and this is a measurement for the price of wholesale goods, and it declined in December 0.5%, which is the biggest drop since April of 2020. So that's, again, just speaking to the fact that it looks like inflation is starting to moderate, but again, I'm not going to deny it's still high. And then, was it yesterday or the day before, Jonathan, the retail sales came out, and they fell 1.1%, which was the worst monthly decline in 2022.
Yeah, a couple of things there. I think to a certain extent, we are seeing consumer spending starting to slow down. We've seen credit card debt increasing. We've seen the savings rate decrease. But I think the other thing that might be in that number too is a shift again towards the service side. And so
coming off the pandemic.
Yeah. And so I think that had an effect as well.
From an international perspective, again, this inflation story is true worldwide. It's not just contained to the US. Global fiscal and monetary policies likely to be a headwind. What we're kind of seeing here locally as well. Now, on the positive, the lifting of the COVID restrictions, particularly in China, will likely help growth. Some have argued that also might be a challenge with inflation because there's going to be a demand in China for a lot of products, but you could also argue that manufacturing is going to be opened up and the supply chains will be improved.
Yeah, absolutely, absolutely.
So I mentioned inflation a couple of times here in the last couple of minutes. Let's look. I'm sorry. One slide off here. Well, let's look at the signaling recession from the yield curve perspective. I was going to show you the inflation heat map, but it looks like that's been accidentally either deleted out of the presentation or we're having some technical issues in pulling it up. So let's go straight to the yield curve. And you had mentioned that it's signaling a recession earlier. This is another way to interpret that information though.
Yeah, and so basically here we're looking at the 10-year versus the 3-month yield curve. The reason this is important is this is the yield curve that the Federal Reserve watches. And so one of the issues we have is the Fed wants to combat inflation, but at the same time, it doesn't want us to go into a bad recession. And so this is certainly a signal for them that we're likely going to see growth continuing to slow. And I think that's one of the reasons why they've communicated that there's kind of slowing their hike cycle.
Sure. So let's touch on our market outlook. And we'll break this down between equities and bonds. We believe volatility is likely to continue, particularly around Fed meetings like per se January 31st / February 1st, and around earnings announcements, which we're coming up into the heat of earnings season, so over the next week or a couple of weeks. The one thing that we didn't put on here that actually just occurred, I think, yesterday, is that Janet Yellen announced that they're taking emergency steps as the debt ceiling fight looms. And so that could probably play into some market volatility if they don't get the debt ceiling raised in a kind of reasonable time frame without too much hype. We talked about earnings. We talked about valuations being more reasonable. I guess that will depend on how earnings come in. Opportunities do look to be more widespread, and we're going to talk about that in a few seconds as it relates to international performance and how it's maybe international markets are a little less concentrated into, those highest flying large cap growth stocks that have done so well pre-2022. And of course, I can't forget to mention again, markets are forward looking, so don't get too caught up in the economic data because you will be driving using your rear view mirror if you do. So how much bad news has been priced in though?
Yeah, so we've been in a bear market, and I think a lot of people are really looking at this and kind of thinking about that. So here we are on the left looking at 2022, the low point, the S&P was down 25%, but earnings actually were up 2%. Now they were projected to be higher at the beginning of 2022 and kind of came down. And then on the middle, we're looking at past cycles where we saw a bear market, but we didn't end up having a recession. And then to the far right, equity performance versus when we did see a recession and a decline in earnings. And so we were down maybe a little bit more than, say, a non-recession, but certainly we haven't seen earnings come down. So we're closer to that non-recession scenario than a recession scenario. And that's really why I think there's been a little bit of a debate about, are we heading into a mild recession? And that does seem like a possibility.
So if we do go into a mild recession, who knows, maybe the market has to find a little bit more downside, but earnings that you would think would definitely have to pull back.
Absolutely.
So how do markets typically rebound though from these big drawdowns?
So again, markets are forward looking and they typically look out 9 to 12 months. And so one of the things we're looking on this chart is some of the big drawdowns from the past, the tech bubble, the global financial crisis, the whole bear market due to the pandemic, and kind of on the far right, the drawdown that we saw in 2022. But what you can see in the prior three instances is very, very large rebounds in the 12 months following the end of the bear markets. And while large caps have had a very, very nice rebound, small caps have done even better.
Now, the one thing, that comes to mind when I see this though, is that in two of these, the global financial crisis and COVID, the rebound could partially be sparked by the enormous amount of government stimulus that went into the system, both in the financial crisis and obviously in COVID. And we're not going to have that kind of government stimulus. As a matter of fact, maybe contrary, we're having the government raise rates and shrink their balance sheet. So, although I do believe markets tend to bounce for sure, I always explain them like they're fishing bobber. If you've ever been fishing, your bobber will occasionally encounter a force that pulls it down. Like the economy or the markets occasionally encounters a force that pulls it down. But the natural state of the bobber and of the markets is to pop back up. So I do believe that, although I do think the global financial crisis and COVID may have been a bit exaggerated because of all that free money.
Totally agree.
Now, you touched on the US dollar a few minutes ago, and this is just basically showing us how the US dollar, even though it's weakened a bit most recently, it's still quite overvalued relative to these currencies that we're showing.
Yeah, so on this slide, we're just showing the Canadian dollar, the euro, the British pound, and the yen on a purchase power parity basis. So think of it as a basket of goods in each of the countries, and then the price differential is kind of showing you the currency effects. And really what you're going to see across the board on all of those currencies is that they are overvalued relative to the US dollar.
Undervalued.
Undervalued, right.
Currencies are undervalued
yes,
relative to
absolutely. So the dollar is overvalued relative to those currencies. And so in the fourth quarter, we did see the dollar start to weaken. And so we saw a positive international performance. And so if we're in a scenario where interest rates start to fall in the US, inflation comes down, we could see those currencies start to do even better relative to the dollar, which would provide a further tailwind to international equities.
And the other tailwind could come from the sector kind of allocation of these.
And you touched upon this before, which is, prior to the pandemic, we were in a 5, 6, 7 year period where mega cap technology did very, very well. And that definitely benefited the US markets, because really when you look at it, basically 80% of the global market cap of technology resides in the US. So very little outside the US. And the other side of that, though, is that especially when you look outside the US into Europe, they have much more in the financials area. When, again, as I mentioned, when you look at Latin America, we're looking at more materials. So in general, those markets tend to be a little bit more economically sensitive, and they tend to be a bit more value. And so if we're not in a scenario where it's only tech, then I do think that provides another potential positive for international markets.
Now, before we touch on bonds, I know some people probably shaking their heads because international's been undervalued relative to the U.S. for several years, and yet really until recently have we seen the international markets begin to outperform. But like anything, the longer the trend goes, the more entrenched people get with recency bias, but the more probable those cycles transition to. So back to our market outlook, and let's touch on our outlook for bonds. Certainly yields have become more attractive as the Fed has continued to hike rates. That obviously had a big impact on the price of bonds last year, but yields are a lot more attractive. Bond valuations, they really are providing more favorable risk return trade-offs, and future returns are expected to improve. I think it'd be quite unlikely to see another period in 2023 like we saw in 2022. And frankly, I don't know, Jonathan, your opinion, but if we did, we'd have other problems.
I would agree, because we're starting from a much higher yield level this year.
Yes. The biggest risk is the Fed may not ease as quickly as maybe the markets are anticipating. And of course, another risk with bonds is always credit quality. And if we do go into a recession, maybe a mild recession wouldn't be terrible from a credit perspective, but if it became a little bit more severe, that's when we really start to see some credit issues. So let's look at bond yields.
So let's kind of look at this. We're looking at different parts of the market within bonds on a kind of 10-year average range. That's the box we're looking at.
The gray dark shaded is the 10-year average.
Yep. And then the purplish line that we're seeing with the numbers, that's kind of the median yield. And then if we look at the diamond, that's the current yield. And so if we look at this, on average, US Treasuries are kind of providing roughly a 4% yield. So again, at the very high end of the range. The same with municipals being at the high end, but again, at 6.8% yield. And so if we look really on the left side of the slide, almost everything across the board, in fact, everything is really at the high end of that 10-year Treasury, 10-year range. The other side of that, though, if we look on the right side and we look at the last three, areas, those are high yield and leveraged loans, which are less than investment grade. And while those yields are relatively high, they're really not at the top of that 10-year range. And so there is a strong possibility that we could see interest rates as we go through the year maybe come down a little bit, but we could see the spreads within these less than investment grade areas widen, because as the economy weakens, we could see more fear of defaults in some of those kind of junky companies.
Sure. Hence, we're proposing stay on the higher quality side of the spectrum.
Absolutely.
So let's touch on portfolio outlook. And I made reference to 60-40 portfolios, 60% equity, 40% bond portfolios, not having a great year in 2022, not necessarily driven by historic downturns in the equity markets, because we've seen a lot worse there, but instead driven by the 40%, the historic negative returns in the bond markets. So this is the third worst 60-40 portfolio calendar year performance since 1952. Now, some people will say, okay, well, what should have I done different? Should I have been in cash? And we're going to touch on that here in a few minutes, but we do not believe cash is a long-term solution for investable assets. I mean, it's a great solution for liquidity and meeting cash flow needs. And I'm lucky, you know, and very happy, I guess less luck because it was more strategy. We went into 2022 with plenty of cash or other liquidity for clients that needed liquidity during the year. So nobody had to sell at a low point. And that is part of the strategy, is you look ahead and you make sure you've got plenty of cash to cover your future needs over the next 12, 24 months, whatever it might be. But for investable assets, we just don't consider cash to be an alternative. We do think there will be a recovery in the bond market. We've talked a little bit about that already. And we still believe diversification is maybe as important as it ever has been. But what this is showing us here, obviously, are those 3 years of really bad 60-40 portfolio performance.
And you touched upon this before. This time around, the issue is that the bond loss was such a significant factor in the 60-40 return, whereas in really the case in the Great Recession situation, we actually saw positive bond returns, and we've touched on
really, really bad equity returns.
Correct. Yes.
Yeah. So with such bad performance from the 60-40, as I mentioned, some people are talking about cash as an alternative investment, strategy. But we really don't believe cash is the answer.
Yeah, and here we're just showing you cash returns in a situation where inflation comes below 4% and in a situation where inflation stays above 4%. And really what we're looking at in a balanced portfolio, again, that we recommend on a 3, 5, and 10-year basis, the returns are so much more than cash. And we didn't really show it, but your issue with cash, even in a lower inflation environment, is you are losing your purchasing power.
Sure. Now, of course, not all of our portfolios are 60-40, right? Each one's customized to the risk profile of the particular client. They could be 70-30, they could be 80-20, they could be 100-0. I mean, it varies, but nonetheless, cash just does not outperform typical balanced portfolios. The other thing to point out is that with 2022 being such a tough year in the markets, that resets future return expectations. So after you come off a series of years when the market does really well, you would anticipate to cycle back down to kind of averages. You'd have to have future returns being a little lower.
Absolutely. Now, you touched upon recency bias. That's tough for people to really kind of fathom, but because the markets are down so much, we're looking at expected returns that are pretty good. And in fact, again, following this very negative period for bonds, again, the US Treasury expected return is going to be about 4%, and US large cap stock expected returns would be about 7%. But we again mentioned that international is a very interesting situation where we've had very bad performance, for a long time, but now we might actually have some catalysts that will potentially bring that performance back a bit. And so really when we look at, developed international, we're looking at 8.8% expected returns and emerging markets at 10%. And as we also mentioned, coming into recoveries, US small caps tend to do better. And so again, we're looking at about 10% expected returns.
And one of my favorite charts, and this is a version of it, I've seen this with some slightly different asset classes or sectors, but One of my favorite charts is this this chart just showing the annual performance of different categories going back. This one goes back to 2003, each one having their own color code. And being colorblind, kind of surprising that this is one of my favorite charts, but it's very easy to look at for a lot of people and just see how recency bias can be so problematic, and how these sectors will transition from really good to really bad in a relatively short period of time.
Absolutely, and we have showed this in the past, but the average investor does less than the average mutual fund because they get caught up in chasing performance, meaning buying the top performing categories of the prior year and selling the worst. And in reality, they should actually be doing the opposite.
Yeah, I mean, I'm just looking here and I think it's REITs. I could be reading the slide wrong since I'm a little color challenged. But we have in 2020 REITs down 8%. Am I looking at the right one? Maybe it's down 6. I can't quite tell. But it's one of the worst.
Mm-hmm.
And then 2021, it looks like what was one of the worst goes to one of the best, and then back down to one of the worst.
Yeah, absolutely. There's a bit of randomness to it. And again, that's really why we think diversification is important. And if we look at the white, the balanced portfolios, they're kind of in the middle. They're never the best, they're never the worst, but it helps people stay invested and staying on track to their long-term planning goals.
So with that, let's transition into our new year planning tips and updates. So as I mentioned, this is a good time, being the first of the year, to kind of go through a checklist of items. And we start with, don't adjust your risk tolerance due to recent market performance, i.e. that recency bias. Just because the markets were down last year doesn't mean they're going to be down this year, or even vice versa if that had happened. This year, April 18th is the tax filing deadline because of a weekend and a holiday. So make sure you get your tax information compiled and to your tax preparer as soon as possible. If we're doing your tax returns, I can tell you we would very much appreciate getting those pieces of data ASAP, and I'm sure if someone else is preparing a return, they would appreciate it just as much. If you have any foreign bank accounts, make sure those are getting reported. Now is not too early to start planning for 2023, especially when it comes to either adjusting withholding allowances or making estimated tax payments. Review spending, utilize HSAs, confirm you're maxing out 401k contributions. You know, these are kind of the basics, but you'd be surprised how many folks end up maybe under contributing because they just don't realize they're not maxing out.
And in fact, with the catch-up, there's been a $3,000 increase this year, and so
for the 401k, yeah,
for the 401k, so you'd want to account for that.
Yes, good point. If you qualify, max out your IRA contributions, or even think about backdoor Roth IRA contributions. Take a look at Social Security statements. You can get those online. As a matter of fact, if you want to do anything with Social Security, you pretty much have to have an online account these days. So if you don't have one, I would request one. Great time to look at the state documents and confirm beneficiary designations. Obviously, if you're working with us, we're rebalancing your investment accounts and looking at year-end dividends and interest and capital gain distributions. Take a look at your insurance coverage, get your credit reports if you haven't gotten those in the last couple years. And I mean, definitely, if you have not yet frozen your credit, that would be high on my list, is to get my credit frozen. And you can do that with each of the 3 agencies we show here. As far as our updates go, well, 2022 is, the tax season is upon us. So we just sent out tax organizers, what was it, maybe a week ago, Jonathan, maybe 4 or 5 days ago. So be on the lookout for those. As far as IQs, walk us through the updates we've had there.
Well, with the market being down, what we saw is negative returns generally across the board. We mentioned that growth was more difficult than value, and that was really on an absolute basis as well as relative. Now that really pertained more to large cap. Actually, mid and small, there wasn't as much underperformance on the growth side. So that was a little bit more balanced. And in international, we again did see that difference between growth and value. What I would say with fixed income being a historically tough year is that our managers were generally in line with the overall credit markets. There might have been a couple that were a little bit better, a couple a little bit worse, but generally kind of right on.
And of course, I'm very excited to announce that we are looking to fill 2 positions. We have an executive assistant and an administrative assistant role that we're actively searching for candidates for. And even better yet, we have 2 promotions that occurred in January. So for those team members that were involved in the promotions, congratulations, very, very well deserved. So let's spend the last 10 minutes here talking about the Secure 2.0 Act. We are definitely not going to discuss all of the provisions of this act. It could be a multi-hour session if we did. But we pulled out some of the provisions that we think will impact our clients the most. Now, the way we've organized it is provisions that are going to affect this year, we'll touch on first. And then we'll touch on some provisions that don't really go into effect until 24, 25, or even after. So let's start with the RMDs.
So starting this year, the age increases by a year to 73, and then in 10 years, in 2033, that age will again increase to age 75.
So anybody that turned 73 this year, they would have been 72 last year, so they would have had to take it last year. But anybody a year older,
correct,
or a year younger, I guess it would be, they don't have to take it this year. If I confuse everybody, my apologies. But 73 is the new age. So if you had not started distributions yet, and we got to January of 2023, and you're 73, this is the year. Okay. Employer matching contributions. These can now be made as Roth contributions. Now there's one caveat. The matching contribution has to be fully vested. And I guess we didn't include it here. The plan has to adopt this. So even though it's federal law, it's an optional federal law. The plan must amend their plan document to allow it. Qualified charitable distributions. If you're not yet taking out RMDs, you may not even know what these are. But for a lot of folks who take out required minimum distributions from their IRAs or 401ks, they may not want necessarily the money that's coming out. They don't want to get taxed on it. So you've been able to gift $100,000 or at least up to $100,000 directly from the IRA to a charity, and therefore you don't have to claim that income as income on your tax return. That's going to now be indexed by inflation. So instead of 100,000, it's going to be slightly more.
Plan participants now can make Roth contributions to both simple and SEP plans. That was not an option in the past, so that adds another feature for those who utilize simple or SEP IRAs.
And this next one, let's hope none of our clients ever have to deal with this. But the penalties are reduced if you were supposed to take out RMDs and you didn't. Again, let's hope nobody on today's session has to deal with that ever. Catch-up contributions, you mentioned that contributions just generally across the board increased, but the catch-up contribution is now going to be increased based on inflation. That provision, though, doesn't go into effect until next year. This is another great provision I really like going into effect next year. You can roll over certain amounts from 529 plan accounts. So these are education accounts. You can roll these over to Roth IRAs. Now, there are some caveats. The 529 plan has to be in existence for 15 years. The maximum you can do is 35,000, or the cumulative amount of the contributions more than 5 years prior to the rollover. But it does allow, in many cases, people who have excess dollars left in these 529 plans to consider putting them into Roth IRAs rather than maybe getting them locked up for future generations. They don't really, maybe aren't even born yet. And then it exempts in-plan Roth accounts from RMDs. So you'll no longer have to roll basically a 401k into, roll into Roth IRAs to avoid the RMDs. This is where you've got a 401k, it's a Roth 401k. Under the old rules, you'd have to take out distributions, RMDs, because it's part of the 401k. Now those in-plan Roth accounts, the 401k accounts, they are not required to take RMDs, even if you keep it in the 401k. The non-Roth portion of the 401k has to fall within the RMD rules, but not the Roth portion. Okay. Catch-up contributions. For some, will have to be made on an after-tax basis. This, again, doesn't go into effect this year, but it does next year, where if you have income above certain thresholds, now your catch-up contributions that you're making, because you're 50 or older, those are going to have to be made on an after-tax basis. We'll deal with that next year. Also, under the provisions going into effect next year, permits matching contributions on behalf of employees who may be repaying student loans. So just keep that in mind. Again, probably doesn't impact a ton of our clients, but maybe our clients' kids. And then in 2025 and beyond, we've got the increase of the catch-up contribution amount for individuals ages 60 to 63. And retirement savings lost and found database will be developed. But again, these are provisions that will not go into effect for a couple of years, including the long-term care contracts. They can be purchased with retirement plan distributions. Again, certain limitations on that, but I'm sure more will be coming with regards to those details. So with that, Jonathan, I want to thank you and again the rest of the team for putting today's materials together. If anyone on today's session has a question or a topic you'd like to suggest, please reach out to your SilverOak advisor. If you're not working with a SilverOak advisor, you can reach out to me directly at 952-896-5701. With that, I'd like to thank everyone for their attendance and wish you a very happy New Year, and I hope you have a great day.